Ladies and gentlemen, good day and welcome to the Q2 and half-year ended FY23 earnings conference call of the Anup Engineering Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. Before we proceed to the call, let me remind you that the discussion may contain certain forward-looking statements that may involve known or unknown risk, uncertainties, and other factors. It must be viewed in conjunction with our business risk that could cause actual results, performance, or achievements to differ significantly from what has been expressed or implied in such forward-looking statements. Please note that company has uploaded the results, press release, investor presentation, and also the outcome of the board meeting on the website of stock exchanges and website of the company. I now hand the conference over to Mr. Puneet Lalbhai, Director of the Anup Engineering Limited. Thank you, and over to you, sir.
Thank you, everyone, and good afternoon to all who have joined this call. I'm Puneet Lalbhai, the Director of the Anup Engineering Limited. Let me share with you that I have with me our new CEO, Mr. Reginaldo D'Souza, and Mr. Bhavesh Shah, our CFO, and Company Secretary, Chintan Patel, on the call. We are officially joining today for our Concall for H1 financial year 23. So it gives me great pleasure to introduce Mr. Reginaldo D'Souza, who we all call Reggie. He has a very excellent track record of performance. His career, which has spanned 25 years with Godrej and Boyce, has many important features that makes him a fantastic person to lead Anup. He has experience around sales and marketing and all the front-end functions of an engineering practice. But what is even more important is that he has also led the estimation, he has led manufacturing, he has led IT, and he has led continuous improvement as well in his various roles at Godrej. He has a proven track record, and we are extremely happy to have him on board with us. And he will of course introduce himself in more detail once I conclude my opening remarks. Rishi Roop Kapoor had expressed his willingness to move onto a more strategic role with the Arvind Group. So he still remains with the group. He is going to look at incubating new technologies and newer businesses in the space for Arvind Limited, and we will have access to his wisdom and his capabilities. He has brought this company from very modest beginnings to where it is today. So his contribution is recognized, and we are happy that he is still with the group and we have access to his knowledge and capabilities. So I would like to now hand the call over to Reggie to introduce himself and talk us through the results.
So thank you, everyone. My name is Reginaldo D'Souza, Chief Executive Officer at Anup Engineering. I come with an experience of about 25 years in the engineering industry. Have been associated with Godrej Group for 25 years, of which around 20 years in manufacturing and operations, and the last 5 years has been in sales and marketing, estimation, and IT. The last 14 years has been with the process equipment business, and hence had the fortune to experience the back end and the front end of a process equipment business in depth. This surely augurs well for my role at Anup Engineering in scaling up and building future strategies for the business, in ensuring sustainable performance in line with our growth aspirations. I am truly excited to lead Team Anup. Thank you and count on the support and guidance from all our well-wishers. Thank you so much. Let me now begin by taking you through our numbers for H1 financial year 2023. The revenue is at rupees 153 crores, up by 8%. EBITDA is at rupees 30 crores, that is 19.6% EBITDA margin. Happy to say that we have a very strong order book of rupees 536 crores as on Q2 end. We expect an annualized growth of 30%. That is, we expect the revenue of rupees 225 crores in H2 FY23. Our new state-of-the-art facility at Kheda, Phase 1, is likely to get commissioned by end of Q4 FY23. The civil and fabrication work to be completed by Q3 end. So thank you and happy to answer if any of you have any questions. Thank you.
Can we start with the Q&A session, sir?
Yes.
Thank you. Ladies and gentlemen, we will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Chetan Vora from Abacus Asset Management. Please go ahead.
To understand that you guided out
Mr. Vora?
Yeah.
So sorry to interrupt. Your voice is not...
Is this fine now?
Yes, sir.
Yeah. What I was asking, that you just stated that for the second half you are looking at a revenue of 225 crores. So that implies the overall revenue of 370 odd crores, right? And at the start of the year we were guiding out for nearly about 400 crores of revenue. So we are revising it downward, is it?
Chetan, we were talking on some growth of 30%. We are maintaining the same levels.
Okay.
30% over last financial.
Fine. And
Yes.
and what's the scenario on the commodity front? The margins have improved on a QOQ level. So how should one see on that level?
So I'll answer that. Chetan, the bulk of the order booking that was done for this year was in the second half of last year, and that is why our H2 is going to be a lot heavier on the delivery front.
Right.
So what will happen is that most of these orders were taken at the peak of the sort of raw material spike, where we had very little time between, actually bidding for the orders and actually the spike happening after winning the orders. So the raw material pressure is likely to continue till the end of Q4. So the margins should remain around what we see them in Q2 for the rest of the year. However, the good news is that going forward, all the orders that we booked post the spike that form a big chunk of this 536 crore order book, they have started returning to the old levels of margins. So we should likely see good margins return in the first quarter of the next year.
So is it fair to assume that of the total book of 540 crores, what we have right now, and 225 crores which is to be executed in the second half. The remaining part of it will be at a normal historical margin of 24-25%.
Yeah, very close to that is what we can say.
Right. Thanks for that. And the other question was that I was looking at the balance sheet. There appears to be that loans given to the extent of 35 crores, which was nil as of March 22. What is this for?
Pardon? If you can come back.
In the balance sheet, the half-yearly balance sheet, what you have filed, the loans given, stands at 35 crores, which was nil as of March 22. What would be this for?
Yeah, it is the loan given to our subsidiary. In Concall balance sheet, it is nullified.
Okay.
It is a contra entry. So in standalone, it is a loan given to our subsidiary, which is operating at Kheda.
Okay. So Kheda is under the wholly owned subsidiary.
Yeah, Kheda is right now at a wholly owned subsidiary.
Fine. And what you have mentioned in the press release that the Kheda will be getting, the first phase will be getting commissioned by the end of the quarter for FY23, right?
Yes, we are confident.
Okay, and this will be what sort of the one? This will be the 2 lines or one bay? What is that?
It is 1.5 bay. It's the first phase. What we have envisaged.
So the complete first phase will be operational, which includes 1 full bay and half a bay. The full bay is used for the assembly, and the cutting and bending will happen in the half bay.
Right. And then last question from my end, what's the order inflow for the year? And yeah.
Yeah. So Chetan, we have booked close to around 300 crores in H1. We are seeing a similar traction for H2.
Okay, fine. Thank you.
Thank you, Chetan.
Thank you. Before we take the next question, a reminder to the participants, in order to ensure that the management is able to address questions from all participants, please limit your questions to 2 per participant. The next question is from the line of Harshil Solanki from FY23 Capital. Please go ahead.
Hello. Good afternoon, team. My question is to Mr. D'Souza. Sir, can you please help us with your vision for the company for the next 3 to 5 years? Which industries and products would be your focus area? Secondly, your export mix currently 17%, and how do you plan to increase the exports? What is the right to win in the export market?
Yes. So articulating my vision for the company, we have started out a very clear agenda. Number 1, we need to diversify in different geography and product category. Mainly I talk about exotic metallurgy. So it will give a higher value per equipment product mix for us. Second is acquiring technology of proprietary products. Third, expanding the capacities and capabilities. So Kheda is a clear example of how we are going to increase our capacity and capability because of the sheer size of that facility. As you all know, it's under the hook 17 meters, which gives us a huge leeway in terms of getting more into heavier, complex and larger diameter equipment. And of course, last but not the least, the strengthening of our organization to build up a strong and capable team to take our business to the next level of growth. So these are broadly the vision articulation going forward. And in terms of what do we see as the growth rate, with the addition of Kheda along with our existing facility, which as we said should be commissioned by Q4, we expect that we should be able to grow at a CAGR of over 25% for the next 3 years.
Got it, sir. Just a follow-up on that. So you mentioned you are looking to diversify across industries and products. So how we will do that? Because historically we have been focused on petrochemicals and refineries. So how do you see we winning orders from other industries? and other products as well.
Yeah. So
Hello.
Did we get disconnected?
Sir, we can hear you.
Okay.
Okay. Yes,
Sir,
thank
I
you.
think so the current participant is disconnected. We'll
Okay.
move to the next question from the line of Kunal from Carnelian. Please go ahead.
Hi, good afternoon, Puneet bhai, and wishing you all the best, Mr. D'Souza. Hello, can you hear me?
Thank you. Good
Yes,
afternoon.
yes. Good afternoon.
Yeah. So 2-3 questions I had. First question was, Mr. D'Souza, what are the challenges you see with Anup presently? And you did talk about the vision, right? So challenges which you believe, which you kind of need to look into is the first question. The second question, you did mention your experience with various process equipments, right? So if you could elaborate a little bit, what specific process equipments would Anup basically kind of look at going ahead, and what are your thoughts on that? The third question being, what is the capacity utilization right now, and this 500 odd crores order book, is it factor in something from KEDA as well?
yeah. So in terms of challenges for Anup, going forward, of course, as we grow, having a strong and capable team to lead this business into the next leap, it would be my first priority. That's a challenge that we have. In terms of, as you all know, on-time delivery has always been a strong USP for Anup Engineering, and as we grow into the next growth cycle, we need to maintain the on-time delivery for the business and also the competitiveness. So as we grow, we need to balance out the on-time delivery performance, the competitiveness, and maintain it so that we are able to take the next leap into the future. And also, of course, streamlining the entire org structure to be capable of delivering this result would be on topmost of my agenda. And also going forward, set the processes and systems to take care of the new challenges that come our way as we move along into higher value chain in terms of complexities and the higher value per equipment. And also, as we have articulated, exports is going to be a strong driver for us going forward. We need to channel our resources and strength, build capabilities to be able to take this challenge of growth in the export market. So broadly, these would be the challenges which we are very well aware of. We are working towards it, and that would be the topmost agenda for me to take this business forward.
So you mentioned on the people part, so it's more to do on the technical side, senior level, sales, marketing. If you could elaborate a little bit on that front, would also kind of help, sir.
Yeah. So when I said we need to build capabilities, basically when we move towards higher complexity in the value chain, we need to build, of course, the technical capabilities and also the softer skills when we move into the exports side of the business. Having said this, I would like to make a note that as I've taken over the business, I'm pretty happy with the team that we have. It's only a matter of consolidating and building the capabilities for higher complexity of equipments in the value chain, which we already have a plan in place and we are working towards it, and soon it will be in place in the org structure.
Fair enough, sir. And on the process equipments part, you did allude to your opening remarks, right? So if you could elaborate a little bit on that also, I mean, what exactly would be our focus area other than the heat exchangers, and how big and fast could this opportunity unfold, and also the areas where we are looking for the technology, either acquisition or collaboration.
Yeah, surely. So Kheda, the sheer size of the plant, that is 17 meters under the hook and 25 meters wide, 200 meters long, that itself signifies the aspirations that we have when we set up this plant. So broadly, when I mentioned that I have an experience on the process equipment side, it was mainly on my experience with the earlier organization, where it was more to do with a high level of equipments in the value chain, especially higher thicknesses, say for example 200 plus of shell thicknesses, more on the exotic metallurgies in terms of titanium and others. And Kheda has been designed, the whole focus going forward would be to have heat exchangers primarily being based out in our existing location, and the Kheda, because of the sheer size, reactors and pressure vessels would be planned for Kheda. As you would have seen from the product mix that we had historically, close to about 75% around, we were always on the heat exchanger side, and the balance would add up to about 20-25%. Going forward with Kheda in place, that's the change that we want to bring about. We want to keep exchangers to about 60%, and the balance is where we want to increase it, so that we do justice to the capabilities that we built up at Kheda location.
Kunal, I think three strengths we've historically had as Anup. I think our competitiveness, our on-time delivery, and our quality. We've hardly had a quality complaint for the last 5 years. I don't think we've ever missed a customer CDD.
Right.
So I think preserving this is going to be key to looking to the future. And I think as Reggie mentioned, just the organization gearing up in terms of systems and processes and getting the right people to have a very fast and successful scale up of Kheda. I think these are the challenges that we need to watch like a hawk and deliver. And I'm extremely happy with the 1 week to 10 days that Reggie has taken over. Already a lot of this groundwork. He's preparing the master plan, and I'm sure he will unveil more of this in the next call. When he has had a full look at the current status and us going forward. But we are in a good place is how I would describe our start point from this moment onwards, and building those capabilities. We have a large degree of confidence. Getting into proprietary equipment, there are several conversations happening, which of course we will inform you as they become more concrete. So thank you for those questions.
Fair enough. So just two questions which I mentioned in the first also. So what is the capacity utilization right now? I mean, this 530 odd crores order book which we have is for ODAV only, right? There is nothing pertaining to KEDA.
Capacity is a moving target. Capacity is a moving target because average equipment value is also changing all the time, right? So the same number of equipment can deliver a higher turnover if your average equipment value goes up, and it's been constantly going up every year. So we are close to full right now, but we will continue to remain close to full with a higher turnover because our average equipment value is going up. Because equipments are all different. At different points in time, different equipment will take up different area under the crane. So it's not as when you think of an engineering bay, you've got to think of time under the crane, which is almost 100% right now, and it will be 100% but deliver a much larger turnover going forward because of the quality of orders that we have already won. So that's how you should think about capacity. I think the additional stuff that will add to this is the clean room at ODAV, and if we are aiming to start with a 500 crore plus opening order balance next year, a big chunk of that will have to be done out of ODAV because there will be a ramp up that we will see at KEDA. So only towards quarter 3, quarter 4 will we start seeing good levels of utilization because we'll have to get the qualifications, we'll have to get the customers in, we'll have to get all the approvals in place for various different types of equipment. So that all will take some time. So next year, towards the end of the year, is when KEDA will start delivering on its full capacity.
Cool. Fair enough, sir. Thank you very much and wishing you all the best, Mr. D'Souza.
Thank you.
Thank you so much.
Thank you. The next question is from the line of Ravi Naredi from Naredi Investments. Please go ahead.
Thank you to give me this opportunity. It is good company have good order book, but EBITDA margin reduced by 530 point in 6 months, and reduces to 11.8% from 16.8%. What is your commentary in future?
So the commentary in the future is that margins are going to be back to the previous levels. This was due to a very extraordinary situation that the industry hasn't seen in, at least my memory, where overnight, because of the war situation, prices of metals soared, and especially in certain categories like nickel-based alloys, it went up by how many percent, Reggie? Almost 200%?
Almost doubled.
Okay. It more than doubled. So if that situation happens in a span of 10 days, 15 days, it's very difficult to sort of maintain the margins. However, the good news is, as I mentioned earlier, that the new orders that we are winning after this extraordinary situation has corrected are back at the old margins. So I would not worry too much about margins as we go forward.
Okay. We will resume this margin by next year, quarter 1, right?
Yeah, so it should get very close. Now, exact numbers as the orders get finalized, maybe this question will be answered with the best certainty once you ask me after the Q3 call.
Okay, understand. And as you said, due to ongoing capex at KEDA and working capital requirement, you expect capex loan. How much the capex loan plan, and will you raise debt only or equity is also in pipeline?
So the requirement for funding the working capital and the capex would be close to around 20 to 25 crores, and we will be taking debt for it.
Thank you.
The bank loan.
Thank you, sir.
But we also feel that this will be very temporary in nature, and our objective of being a zero debt company is still very much in force. This is just a temporary mismatch of cash flow for which we are we are taking a look.
But sometime it is good when you take the date for expansion of company. It is good.
A lot of different people will have different philosophies on that one.
No. It is always good.
I will assure you that we will not stop our growth for want of funds.
Yes. Instead of raising equity, debt is always cheaper.
Correct.
Yes. We'll go for that.
Okay. Thank you.
Thank you. The next question is from the line of Ankur Sanwal from Money Matter. Please go ahead.
Thank you for taking my question. I wanted to ask that for developing new products, are we going to have any technical assistance from other companies, collaborations for technical know-how for making new products?
Yeah, so I'll answer that question. So talking about technology, we are already licensee to Lummus heat transfer for our helix heat exchangers, which form a large chunk of our heat exchangers that we manufacture in the current facility. We would like to expand that going forward and be licensee for such similar technologies going forward, so that we can improve our portfolio into these proprietary items, so as to be able to compete better and improve our order book positions. So the focus is there. We are already as a licensee, and going forward we have more technologies in mind we want to take forward.
Thank you.
Thank you. The next question is from the line of Bhagwat from Prosperity Wealth Management. Please go ahead.
Good afternoon. I would like to better understand the decision of Corbin Group to start a separate engineering division. Why not have the new business as an extension of Anup Engineering itself? Is this new engineering division a significantly different business than Anup?
So I think we are in a very exploratory phase right now. So nothing. We have not yet zeroed in on the opportunities. See, right now the bandwidth of Anup team has to be fully utilized to delivering this growth, delivering the right margin, delivering this transformation where exports constitutes a very large part of our order mix, delivering a future where our dependence on petrochemicals and refining is not as it is right now, and getting phase 2, phase 3, phase 4 of KHEDA off the ground. So there is more than enough to do within Anup for Reggie and his team to handle. That is why we've taken Rishi. I mean, we've sort of charged Rishi with looking at opportunities. Be they logical for Anup? If they are logical for Anup, they will be transferred to Anup. If they are something that is complementary but does not belong in Anup, we will do it elsewhere. So just this scanning the space and thinking strategically about the space is the initiative that Rishi is going to lead, and it is best done by somebody who doesn't have the mandate and compulsion of delivering on the Anup agenda, because we don't want to dilute the focus on on Anup. We have to we have to improve our systems and processes, our project execution, we have to go and win new technological tie-ups, we have to gear up for the export market, and so we have a big agenda in front of us. That is the logic behind having these separate sort of verticals. One is an exploratory vertical at this point, and once those opportunities become real, if they are adjacent or if they are directly relevant to Anup, of course we will not build them separately. They will get transferred here.
Okay, so sir, it's a completely different business, not somehow very similar to Anup's business?
Yes, but we might stumble onto some opportunities that might be relevant to Anup, and there, having those preparatory dialogues, getting that from 0 to 1, all that requires a very different type of focus, which is better done separately, and once the opportunity becomes real, it can be housed anywhere. So this will only help Anup rather than any concern of it creating a parallel organization. Of course, rest assured that we will never do anything to sort of compromise Anup's positioning.
Okay, so if you could give some color on the business model of the new division, just some basics.
So right now it's only a team of people that's going to scout for strategic opportunities, and those strategic opportunities, this team is a week old. so again, I think this question is better asked, once the team has, sort of articulated its thought process, and since this is an Anup call, we'll discuss, how it is relevant to Anup. That is a fair question, and my answer to that is that it will only add opportunities to Anup's quiver of arrows, and help it achieve its vision.
Okay, understood, sir. Second question is what would be the top line and margin anticipated for FY23 and FY24 as a whole?
So as we mentioned as Reggie was talking earlier, I think, we are going to aspire for that 24% kind of margin on a 25% annualized, CAGR growth. So that, you can easily do the maths, right?
Okay, so sir, as previously we have been guided that Anup will reach 400 crore of top line. So is that guidance still written?
So we are guiding now that our visibility is of 225 crores in the H2. So that will leave us slightly short of 400 crores is what we are feeling as of now. Of course, there will be every effort to do better.
Yes. And sir, from FY24 Q1 onwards, the margins should improve as we have discussed.
Exactly.
Okay. Thank you, sir. That's from my side.
Thank you. The next question is from the line of Sonal Minhas from Prescient. Please go ahead.
Hi, this is Sonal. Am I audible?
Yes. Good afternoon.
Good afternoon, sir. Good afternoon to everyone. I had two questions. The first one, just wanted to understand the price escalation mechanism or the contractual escalation mechanism you have with your clients, because as you mentioned, the prices of raw material went up by 200%. So what gets factored in, what gets passed on, and how are these negotiations happening given the times of turmoil? So I'll just pause here. I just wanted to understand that first.
So there are two types of customers. One is tender business, where unfortunately the industry is structured in such a way that there is very little opportunity. Once you've bid and you are L1, you only have a choice of accepting the order or rejecting it, right?
Okay.
Then there is very little actually price escalation built in, but that usually doesn't matter because the window between, becoming L1 and actually getting the PO is not inordinately long. So only a massive spike in a very short period of time can result in something like this. If you look at Anup's history, we have not faced something like this in the past, So, and even the world hasn't faced something like this in the past. That said, we tried our very best to go back to customers and request, but contractually, a lot of those provisions don't exist, and when they don't exist, your negotiating power is low. That said, we managed to get some marginal increases here and there. Now,
and that's for Indian as well as international customers? Or
no. This is tender business. So I'm coming to others. Then there is non-tender business where it is a one-on-one negotiation where a lot of these mechanisms are built in. Now it so happened that a bulk of our orders that we clicked were very attractive tender orders. So it was just, a matter of chance that the percentage of orders at that point in time when this escalation was happening, a good chunk of it was this tender business. So there we were rather helpless on cost escalation. But going forward, we would also like to have a good mix between tenders and sort of negotiated private, negotiated contracts with private companies. So generally there, like in other standard contracts, there are escalation clauses. Of course, there are caps to all these things, and every cap would have been sort of blown out of the window with the kind of escalation that happened this time around, but it would have been slightly better had those mechanisms been in place. But as I said, because most of those orders were tender orders, we got particularly badly hit. That said, I think the kind of effort that the team has put in to come to the current levels of margin after the level of escalation that had happened is worthy of nothing other than applause, because they did a lot of hard negotiations, they did a lot of work on design, did a lot of work on cost and efficiencies to be able to recover significant margins. It was looking much bleaker than it's actually landed up.
I appreciate that, sir. This is a tough time, but I just want to understand, because the commodity prices have been up for the last 6 months, and we've been accumulating our order book since then. So there would have been a time where you could see that the prices are going up, and maybe being L1 during this period, or maybe you would have ended up rejecting some orders based on your bids, because
so we did reject a few orders, but then, we also have to deliver, on the growth agenda. So you can't reject everything. And, these are good customers, these are good orders, and this is a short blip in time. So, we just have to, smile it out and forge our way through a difficult patch. And that said, 20%, if you compare to the overall industry, is not it's not our Anup great margin. It's a decent.
It's better than everyone. I think a lot of people actually. Maybe
so
it's in the top
that,
10%.
It is a bit rich to be rejecting orders and upsetting customers.
Just trying to understand, you said you're growing and expanding your exports business. When you compete with certain larger players on the exports market, what are the technical criteria basis which you right now get rejected, or you have kind of a lead time to qualify, which you see basically becoming right for you, or they be getting switched on for you in the next 2-3 years? So
there are two things that we have to keep in mind here. Number one, we haven't really even courted those customers. So it's not, there's not a situation where we are getting rejected. It's that, we've been full with, this set of customers with good margin, that there's been not much opportunity to go and, see, if you go to an export customer, you better be able to deliver, right? So when you are already this full with a very decent margin, and your capacity expansion has not yet fully happened, that's not the time you go and, excite a bunch of people. So that's number one. Number two, the order facility is constrained from its location perspective also. It's landlocked, and the space is, very limited. So a lot of the export customers that require large equipment, etc., would not, even consider this manufacturing location. So we've not gone to that set of customers also, which we know that if they come and see the facility, they will have the first question around logistics, and that will be before they even look at our systems, processes, and shop floor, it would become a constraint. So these are the issues of why we have sort of focused on this set of customers, which itself is giving us good bottom line. I think the right question to ask is what will happen after KEDA, and there I can assure you that any export customer will love the infrastructure that we are putting in place. It's going to be a best-in-class kind of infrastructure.
But is there a lead time there, sir? Because what I understand, especially in your industry, there are with the export customers, you have a lead time to qualify for taking orders, and it pans out to 2 to 3 years even then.
Yes, but there is also existing, so we do have export customers already. We are qualified for a lot of export customers. and those customers can start utilizing the KEDA facilities. So while new customers will send their people, they'll do their inspections, they'll get confident about our capability to deliver and then place orders. There are people that already trust us, where we have a 100% track record already. So those people will be quicker to place orders, and part of the 536 crores that we already have, there are some orders specifically taken for KEDA, which will start up in Q1. So there, and we don't want KEDA to ramp up beyond a certain pace, because we want to be able to digest, the orders that we get and continue our promise of 100% on-time delivery. So we will take it at the right pace. And Q4 is when the action will start to happen on getting, newer customers qualified. I think one of the things where we are very well placed is that Regi has, relationships with the best of all customers globally, and they are eager to be able to, come into India and have a new supplier, because today there are only 2 or 3 people who can service their needs, and the shift away from some of the Southeast Asian and Chinese supply chains is only going to add that necessity of looking for more options in India. So we feel very confident with the kind of infrastructure that we are creating, with the fact that Regi has known some of these customers whose orders we would want for better part of the last 10 years, and has very good relationship, and many of them are excited by KEDA's development. So these two factors combined makes us very confident. That said, what we have to do is ensure that KEDA, ramps up properly. So we have a lot of work to do. We have to build a team. We have to ensure that our project management from here to the end of Q4 is done well, so that there are no additional delays. And we have to, ensure that we are taking the right orders at the right time, so that our ramp up is seamless. And we continue the promise of being competitive, delivering 100% on time, and not having any quality issues, which has been our hallmark till now.
Yeah, so Sonal, just to add to that, whilst we are preparing to gear
The
ourselves...
operator, sorry to interrupt.
Yeah.
So actually, the participant is disconnected. Can we move to the next question?
Sure.
Thank you. The next question is from the line of Rajesh Jain from NB Investment. Please go ahead.
Good evening. Sir, it's regarding the tendering and the standard orders that we have received. Is it fair to say that all this tendering business that we receive, it is from the PSU only?
Yes, largely PSU. You're
okay.
Right.
And just to get an idea, maybe in FY22 or in H1 FY23, how much of the revenues are from these L1 type of orders that we have executed?
Yeah, predominantly we are right now all the refining and petchem orders are, so you may say domestic orders are all L1 category orders.
Okay, fair enough. So second is, in the last call, it was announced that we had received one big order worth more than 100 crores from a refinery. So just curious to know, one, was it for heat exchanger? And was it only one heat exchanger, or was it more than one?
No, it was 36 heat exchangers.
Oh, 36 heat exchangers. Okay, nice to know that, sir. Sir, my next question is, sir, we had a good track record of keeping the debtor days within 100 days. And we know last 2 years things are not normal. But is it possible that we bring it back to 100 days, maybe in the current year or next year, or will that 150 days has become the new norm?
So yes, in case of domestic customers, since advances are less, you may see this continuing this way. If we go more in exports, then our debtors day will come down.
So you mean to say till we commission KEDA and concentrate more on exports, till that time the debtor days would remain at the current level?
Yes.
Okay. So regarding KEDA plant, see, we have expansion in 3 phases. So as per the existing plan, so when is this third phase is expected to complete?
Third phase?
Yeah, the third phase we are expecting to complete by FY26.
FY26. Sir, after that, do we have some more space available there?
Yes, KEDA FSI is much higher than what all the 3 plants put together it is.
Okay, so that means is it possible to put one more bay?
We can put a total of 7 such bays. At KEDA, we are doing 1.5 right now.
In the phase 1, but for all the 3 phases...
We can do about 150 crores.
I know, sir. No. What I was asking is, in the 3 phases that you have planned as of now, how many bays we are going to put up?
1.5 bays in first phase.
I know. Phase 2 and phase 3?
It would be kind of equivalent. Maybe 3 and 2.
3 and 2. So agreed. So that means we would be having around 3 plus 2, 5. So another 2 bays we can put up.
7 bays.
Total 7 bays. Okay. Sir, my next question again about the KEDA. See, once it is commercialized with the kind of overheads that you would be having there, how much time do you foresee that it will take to break even at that place?
Yeah, so break even at KEDA would be, so in phase wise we are seeing close to around 75 crores as a break even point for first phase.
Okay.
Yeah, so and then going forward, since we will be adding up the facility in a phased manner, the break even point will change.
I know. So these 75 crores of revenues that you can generate in FY24 itself from KEDA?
Yes, we are targeting that.
You're targeting. And lastly, just wanted to know what would be the interest and depreciation cost for FY23 and 24, sir?
FY23,
that is the current year.
Yeah, FY23, the interest cost would be just maybe at around 50 to 60 lakhs, and depreciation would be close to around 10-11 crores. KEDA will come the next year only.
Okay.
And going forward in FY24, we expect interest cost to be 2 crores and depreciation to be at 20 crores.
Okay. Thank you very much, sir, and wish you all the best.
Thank you. Bhavesh, may you circulate the exact numbers if they...
Sure. I'll be happy to, if you just send across a mail for such questions, we'll be happy to reply it.
Thank you. A reminder to the participants, please limit your questions to 2 per participant. The next question is from the line of Akshay Kotari from Envision Capital. Please go ahead. Mr. Akshay Kotari, your line is in talk mode. Kindly go ahead with your question, please. As there is no response from the current participant, we move to the next question from the line of Anurag Patil from Roha Asset Managers. Please go ahead.
Thank you for the opportunity. Sir, for KEDA phase 1, how much is the total planned capex and how much we have spent till now?
The planned capex is 115 crores. We have spent around 60 crores till date.
Okay. And sir, what are the typical asset turns for this facility?
We are looking at an asset turn at good levels at 1.5 to 2 tons. In initial phase, it would be 1.5 tons since we are developing a complete facility of KEDA along with it. Going forward, it would be 2 tons.
Okay. And sir, for our existing products, what will be the total domestic addressable market size for us?
It depends on the capex cycle. Right now, we are seeing a good capacity expansion both at refining as well as petchem. So right now, the overall inquiry pipeline, I mean, just to give you a rough idea, our hit rate is close to around 18 to 20%.
I think on market size, we can circulate, we have that data. It's just not handy, so we don't want to talk a wrong number. We'll get back to you on that one. We'll make a note of it. I mean, it's a very large market.
Okay, sir. That's it from my side. Thank you very much.
Thank you. The next question is from the line of Surit Deora from Palladian Capital. Please go ahead.
Yeah, hi. Thank you for the opportunity. I've been tracking the company for a couple of years, and the question that's always in my mind is on the demand side. I've not been able to get a grip on what is driving the confidence for this new expansion, because the existing facility, I believe, can do about 500 crores of turnover, which has not yet been achieved. And it seems to me that the revenue is still mostly concentrated with heat exchangers and the refining sector. So could you just, maybe this has been answered earlier today, I'm not sure, but could you just help me understand at a high level how you're thinking about it?
I'm not sure I fully understand the question. So if I were to rephrase it, I think what you're asking is that why haven't we been able to achieve 500 crores in order when we say the capacity is at 500? Is that the question?
Yeah, that's the first part, and the related part is that we've not been able to hit that, and most of the revenue is still coming from heat exchangers and refining, and there's a lot of emphasis, of course, on the new facility at Kheda. So how are you guys thinking about
refining and petrochemicals specifically is here to stay for the next 10 years, despite all the focus on renewables. So it's not in a category that's a sunset category by any means. That's what our analysis of the industry says. So while it is important to start building newer sort of avenues for diversifying our segmentation of where we get our orders from, oil and refinery, we have an excellent track record. We have very good relationships with customers, and it's here to stay. So that's not a concern area. Now, coming back to the first part of the question, 500 crores is a recent development. So we have been adding capacity at Odhav every year. The way you have to think about it is that our average equipment value 2 years ago was, I think in the 1 crore range. Now it is 2.7 crores on this order book. So while we were doing between 150 to 200 process equipment pieces, we are still doing those 150 to 200. So we are utilizing the full capacity, but the turnover is going up because the average value per equipment is going from 1 to 2.7. Right? So that is a gradual process because we added the heavy bay, last year. This year the clean room is coming up. So all these things will allow us to get higher average equipment value. We'll still continue to do that 150 to 200 equipments from Odhav. Does that clarify it?
Mr. Deora, please confirm if you're able to hear us.
Your voice is cutting out.
So it seems like we lost the connection for Mr. Deora.
Okay.
We'll move to the next question from the line of Saket Kapoor from Kapoor Company. Please go ahead.
Yeah, namaskar, sir, and thank you for this opportunity. Sir, this is yes, some of the things, the low margin order booking will get exhausted by Q4 of this financial year, and we would be trying to return to our previous EBITDA margin of 25% in terms of the orders which we are booking currently and going ahead. This should be the sum and substance in terms of the margin profile. And going ahead...
With one correction, the lower margin orders, which is still industry leading. But you are right. I'm just being a little facetious here. Sorry.
Sir, come again, sir. I missed the point you were trying to make.
I just said, yes, you are correct. but the low margin that you're talking about is still a good margin.
It's a good margin, sir, but it was not historically the one which we used to post. That was my reason, sir. I should have corrected that.
No. I'm just joking.
Yeah. No, not an issue, sir. Not an issue, sir. And secondly, sir, coming to the new growth which comes only from the Khera contributions, sir, going ahead. So that
I would not say that. I think until we reach 500 crores, I think ODAV will stabilize at 500 crores. Is that correct, Reggie? You would like to answer that question?
Yeah. So Kheda, with the current capacity that we built in and the product portfolio that we are looking at going forward, we have a fair good understanding that ODAV would be to the tune of 500 crores, and beyond that is where Kheda will chip in. And in the first year, we are looking at 75 crores to 100 crores turnover from Kheda with the 1.5 bay commissioning that's going to happen in Q4.
But the revenue is going to kick only for FY24, not for this.
Talking about FY24 only.
That's correct.
And it will take some time to also go to 500 in ODAV. So, both those things will happen parallelly. Kheda will start and ODAV will start, going from the current level to 500 crores. That is also in process.
Sir, when we look at your capital work in progress, there is a increase of from 30 crore to 60 crore. That is totally in terms of the money going through the Kheda capacity?
Yes. All CWIP, 95% plus is all about Kheda.
Okay. And when we look at the other current asset, that has gone up from 13 crore to 33 crore. So what would this could you explain to us the reason for the same?
The current assets.
Yes, sir. Other current assets was 13 crore for 31st March, and now it has gone up to 33.3 crore.
Okay. Just a minute. I'll get back to you on this.
Right, and employee cost has also gone down, sir. If we compare last year numbers, we had an employee cost I think of 7 crore, and this time it is 5 crore. So what explains this the reduction in the cost, sir?
So there is a lot of I think when you look at there is a part of employee cost that is also variable, and because we have had a low Q1, that's why that expense is also lower. That will correct once we are back to full capacity.
Okay. And sir, just to get an understanding, what should be the ideal package for Mr. D'Souza as a CEO at the industry levels, or because of his expertise and his experience? If you could give some more color to that.
So I think Reggie comes with some of the best industry credentials. So whatever package we will do now and going forward will be concomitant with his capabilities.
Okay, right, sir.
Thank you. The next question is from the line of Ankit Babel from Shubhkam Ventures. Please go ahead.
Sir, good evening. So my first question is, as you mentioned, Bhavesh Bhai mentioned that the break-even point in the Kheda capacity is around 75 crores. And since you people are expecting a revenue of around 75 to 100 crores from Kheda in FY24, so I believe that then in that case, how are you going to achieve your 24-25% margins for the company as a whole? Because this 75 to 100 crore revenue might not have that margins.
Yeah, so at overall levels, what we are seeing is about 100 crores from Kheda and 400 crores from here. So 400 crores at ODAV will be at the normal levels, and 100 crores will be generating about the same level. So fixed cost over at Kheda, we are estimating close to around 15 crores to start with.
See, this doesn't, I mean, it's very difficult to predict all this quarter to quarter. I think we should look at, I mean, the broad guidance that we are talking about here is, barring the mismatches of, of the execution ramp up. So quarter to quarter, there may be variations in this, but overall, if you look at 3-4 quarters combined, and if you look at the end of the scale-up process, we should land at that 24%.
I understand, sir. I'm not talking about quarter to quarter. I'm talking about the full FY24 full year. So in that year, only a 400 crore revenue might generate a 24-25% margin, which is the Uddhav, and this 100 crores from Kheda might do hardly what, single digit, I don't know. So overall, I mean, how are you going to manage the margins at those levels? Or in case you would like to tell me that Uddhav would do a 27, 28, which also you people have done in historically. So just wanted your view on that.
Yeah, so we are talking about the consolidated margins. The individual margins, this will be worked out accordingly.
No, so are you saying that the Uddhav has the capacity to do a 27, 28% kind of margins?
No, so I think you are right in saying that, maybe the consolidated margins for the next year are likely to be slightly lower. But we have to bear in mind that, it is, we are overall booking orders at 24%, even if you look at Kheda. So, I mean, when we talk at 24%, we've already made some assumptions around Kheda. Now, anything that is an execution related,
that's fine, sir. That I understand. Yeah.
That may actually happen, So it's very difficult to sit right now and tell you that everything is going to go absolutely to plan, and what we have planned is almost 100% going to materialize. So yes, you are right. It may go lower because of some execution related things, but I think we have to allow for all of that in the ramp up of any enterprise. But at the order level, with Kheda costs factored in, we feel that we are taking orders at 23, 24, 25%.
Yeah, I was just trying to understand the mathematics. That's okay, sir. I understand.
Understood. We'll get back to you once we freeze up the budget for the next year.
Okay. And how come a lower Q1 revenue impact your employee cost in Q2, sir? I didn't get that.
Pardon?
How come a lower revenue in Q1 impacts your Q2 revenue cost, 2Q employee cost?
No, the employee cost is the variable component, which has been identified based on the KPIs, has not been disbursed based on Q1 performance. So it will be disbursed as and when it accrues. It gets factored in the salary cost.
Okay.
Yes. Okay. So I mean, I stand corrected. The main reason for which the employee cost has come down is not because of the variable component. There must be some factor of that because of Q1, but you are actually talking about Q2 numbers. So in Q2, normally Q2 is when we pay out variable. This year the variables got a little delayed. You will see it come in Q3.
Okay. That's it from my side. Thank you so much.
First, the question which one of the participants asked about the increase in current asset, I mean, this is because of increment, the vendor advances which we have paid, for which the material is going to come in H2. So that was one answer which we haven't given. So yeah, that's it. Thank you.
Thank you. As there are no further questions, I would now like to end the conference. Over to Mr. Puneet Lalbhai for closing comments. Over to you, sir.
Thank you very much for being on the call. Look forward to seeing you all next quarter.
Thank you. Ladies and gentlemen, on behalf of the Anup Engineering Limited, that concludes this conference. We thank you all for joining us, and you may now disconnect your lines.